Welcome back to yet another Hargreaves Lansdown ISA stocks and shares portfolio update. For those of you that don't know me, I'm Jack. I'm a full-time investment professional working for a wealth management company. I'm a CFA charter holder, and as part of this series that's been going for a couple of months now, I basically talk you through my Hargreaves Lansdown ISA. So we've got 6 funds in there at the moment, 6 mutual funds from all across the world, covering different themes, and I'll basically take you through the different funds, the portfolio as a whole, how it's performed, and then talk a little bit about markets, because although the portfolio hasn't moved too much and I haven't been able to invest much more, under the surface the markets have actually been quite active, and yeah, not just equities, but also in the currency market a lot's been going on. So we're going to talk about that in today's video. So yeah, hope you enjoy. But before I do go on, just need to remind everyone that this video is not financial advice. This video is for entertainment and education purposes only. So with that said, we'll come on to the sort of Excel dashboard that I've got, and then we'll come on to some charts a bit later on. Okay, here we are, dashboard time. Starting at the bottom, we've got the contributions. Haven't been able to add to this portfolio for the last couple of weeks because I don't get paid until 2 weeks time, and sadly this YouTube channel is not paying me any money just yet, so no side hustles like some other YouTubers. We've just got the one income source. Yeah, anyway, a bit of a tangent. No more portfolio contributions just yet. So scrolling up then, we can see that, yeah, as I said in the intro, the portfolio value hasn't moved around too much. We've only gone from 423 to 469. So a bit of gains. What's that? 40? Yeah, £40. Won't say no to that, but yeah, definitely nothing major. You can see the portfolio over time here. When we come onto the charts, you'll see that I started this series at possibly the worst time I could. So, you know, in my head, this dark blue gain bar would be on top, and it'd look nice and smooth, and it'd look all brilliant. But that hasn't happened quite yet. Give it time. I'm sure it will come good. And then we've got the portfolio over time. You can see we had a big dip pretty much straight off the bat, which, yeah, wasn't great, but we can move from there and move on. On to bigger and better things as time passes, I'm sure. The portfolio as a whole, I've got breakdowns of all of these funds on the rest of my channel, and I talk about these in every video, but I'd expect there's a lot of new people here, so I'll give a quick overview of what the portfolio is supposed to look like. We've got 3 funds that are more defensively minded, and 3 funds that are more sort of aggressive and yeah, more volatile. And it's all in equity portfolio. I'm only 24, so I need that extra return potential, and I can stomach the volatility. So let's just run you through the funds very briefly. We've got the defensive components are Polar Capital Global Insurance, which focuses on insurance companies. We've got Fidelity Special Situations, which is a UK-based fund, active fund in the UK, picking stocks. And then we've got the LNG Health and Pharma Index. And funnily enough, excuse me, the Health and Pharma Index has been the worst performer in terms of what I expected from it. So you can see Columbia Threadneedle Smaller Companies, which is one of the aggressive components, alongside BlackRock Unconstrained and Henderson Tech Leaders. Just quickly on those, BlackRock is basically the best ideas from a hedge fund team of BlackRock, quite concentrated equity portfolio, global. And then we've got Tech Leaders, which, as the name suggests, is the leaders in the technology space. Anyway, the idea behind the Health and Pharma is it's supposed to be that defensive sort of steady Eddie type return, but you know, there's a number of factors that have played into that poor performance. Novo Nordisk on the weight loss drug side has been smashed. United Healthcare had their CEO killed, and then they missed an earnings, so that's been smashed as well, which is a huge weighting in this fund, in this portfolio. And then you've also got RFK and Trump coming at pharma, trying to target prices. So that's been the worst performer in terms of where my expectations were. The other 2 defensive components have actually done really well in this more rough market. So Fidelity Special Situations is up 6%, as you can see. And then Polar Capital Global Insurance, despite being US dollar denominated, which we'll come on to soon, is actually up 0.22%, which is really good. And then we've got, yeah, the more aggressive portfolio components down, which you'd expect. The worst of which is Columbia Threadneedle American Smaller Companies, which has been hit firstly by the Trump situation. So the tariffs, the war, all of the uncertainty basically comes into smaller companies the hardest because they're most sensitive to that sort of thing. And then they've also got the fact that obviously they're American, so they're US dollar denominated, and the US dollar is down a lot, which has hurt as a UK investor, and it's why that debt fund is down 13.5%. So I've been asked in previous videos why you're not in stocks. The first answer for that is scale. So I'm using Hargreaves Lansdown for this, and yes, I probably shouldn't be, they're quite expensive, but it means that holding individual stocks with the fees, I think it's £12 to buy, £12 to sell, and then you've got transaction costs for foreign investments, so Forex, if you're buying American companies, it adds up, and it means that you basically have to earn almost 10% to even break even, which obviously is not ideal. So that probably will come, but it's just when the scale sort of picks up in this portfolio. And then it also makes it easier to have a diversified portfolio when you're a smaller investor. And I personally like the volatility and return profile you get from funds, even if it is a bit muted as opposed to a pure equity portfolio. So yeah, that's the overview. I think I've run through that fairly quickly, fairly comprehensively. So let's go on to TrustNet now and talk about some charts. Just quickly before I do that, I just wanted to share with you the impact of the US dollar and what that's had on investments as a UK buyer. So firstly, it's a pretty cool dashboard I've got here, isn't it? It's my TradingView account. You can see some stocks that I like, some watch list stocks, the insurance, top holdings, and then my main sort of dashboard. But anyway, the reason I bring this up is since the start of the year, the pound is up about 12% on the dollar, which means obviously that if you had a US dollar at the start of the year, it's now worth 12% fewer. Well, it's not quite because of the way that ratio works, but around 10%, it's worth about 10% less in pounds. So if you're an investor in the UK that's had an all-in equity allocation to US equities, then you're down 10% purely from currency. So it's been a big headwind. It's actually been a tailwind for much of the last few years and decades, really. Obviously, since the Liz Truss moment, it's been better for the pound. But if you've been in US equities for any of the last 15 years, really, you've done pretty well out of it. So yeah, it's not been too good. I mean, I would like ideally to move out of the US dollar where I can, move into hedged share classes, but I don't like to sell low or buy high, and I feel like buying the US dollar up here is not the greatest timing. So yes, I'm trying to time the currency markets. Yes, that's probably a bit stupid, but I've been around finance and markets long enough, I feel, even if it's a mistake, I'd rather not buy up here. You know, even if it just pulls down to here or it goes up a bit more and I eat some more pain for a little while and then it pulls back to here, I just feel much more comfortable doing that. So that's the currency covered off. And let's come on to TrustNet now. So on screen here, we've got the performance of my portfolio basically since the start of 2025. And I started the series here and in sort of February time. If we expand that out, let's expand it a bit longer just so you can see the awful timing here. That's the start of the series, and that's what happened after. This is the last 5 years, so I picked any time in the last 5 years. Couldn't have picked a worse time to start the series. Anyway, yeah, that's what's happened. That was liberation. That was when the tariffs started and the Israel tensions sort of started to pick up a little bit more. Yeah, the tariff stuff was the big thing, and that really hurt markets. We've had a bit of a rebound, and if you actually look at the S&P 500 in US dollar terms, or global equities in US dollar terms, they're pretty much back at all-time highs. But again, we've got that US dollar headwind as a UK investor, so we are down, what's that, about 5% from the peak. But a big recovery. I've said in a previous video that I think this recovery is a bit overstretched, and I still somewhat think that. It's just it's trying to balance the US dollar and the spot or the underlying stock movements. Like I said, I don't mind being fully invested. I'm a long-term investor, but it's just that US dollar is niggling at me, or naggling. I don't know if that's a word, but it's sort of a bee in my bonnet, let's say, going forward. And then just to show you the constituent parts of that portfolio and how they've performed since the big drop. Fidelity Special Situations UK Fund hasn't had the US dollar tailwind, headwind obviously, and the UK's been in a good spot, so that's way out in front. Polar Capital Global Insurance, very impressive. The hedge share class is making all-time highs. that sector is just perfectly poised, in my opinion, not financial advice, for the next 3 to 5 years. And that's flat over the period year to date, pretty much. And then on the sort of opposite side of the spectrum, you've got US smaller companies, which are covered off on the Excel dashboard. And then you've got health and pharma, which you can see really did their job in many ways on the big Liberation Day drop-off. So the other three, the aggressive side of the portfolio, big drawdowns, big bounce back. Health and the UK and Polar Capital Global Insurance didn't see that big drawdown. They held off really nicely. The other two had a pretty decent-ish recovery, and the healthcare, due to macro headwinds, has failed to do so. So I don't mind holding that for the long term. If I bring out, say, a 10-year chart, okay, I can't do that because of BlackRock. Let's do that again. If I bring out a 10-year chart, and we can see, I do have a short on my channel against the healthcare sector and the global sector, which I suggest you go and check out because it's quite interesting. Basically, it's the same performance for lower volatility, or has been historically. But yeah, just to quickly throw that up on the screen now, I've taken BlackRock off because the track record doesn't go back 10 years. But you can see that all the other funds have pretty much smashed it, apart from Fidelity, which is the UK fund. And the reason for that is the UK has been completely out of favour for the last, 10 years, 15 years, maybe even 20 years, really. But if you think about markets more of a coiled spring as opposed to a sort of perpetual motion machine, in my head, which is how I think about markets, the UK has been squeezed and squeezed and squeezed and squeezed, and now it's quite cheap. And I'd like to think that over the next 5 or so years, that can re-expand, and you get that benefit off the back of the people that have suffered over the last 5 to 10 years. Using that same logic, you'd think that tech leaders should be underweight in my portfolio, and again, that Polar Capital Global Insurance and smaller companies should be underweight because they have outperformed the IA global sector. But those areas I feel have long-term secular tailwinds anyway. So again, if you go back to my other videos, you'll see what I'm talking about there. But yeah, anyway, that's the chart for the global sector. You can see it's F there in and amongst those different funds. And the only one that's underperformed materially is the UK, but I think that's got room for recovery. So a bit of an all over the place one. It's my first video recording of this series in like 3 weeks, so forgive me if it's a bit rusty. But yeah, should get paid soon, contribute to the portfolio, and see that number rising. So thank you for watching. If you enjoyed, leave a like and subscribe, and I'll see you in the next one.